I have to confess we're going to be discussing some topics that are quite tricky for a journalist, because any promising technology announces itself with quite a lot of hype, and journalists, and particularly British journalists, are a sort of nasty, sceptical, cynical bunch, and we can come over a bit allergic to all of that. Now, the advance of artificial intelligence, or AI, is definitely not an exception to this. I've heard breathless equity analysts saying things like, we've got a step change in corporate profits coming that hasn't been seen in human history. And, you know, perhaps, I think we can all think of several ways that generative AI in particular can make people's jobs more productive. But usually when you get that kind of breathlessness, it sort of more indicates that it's time to sell the market than that the world's actually being transformed. But away from the hype, I don't think anyone would deny how much technology has changed business, and particularly the business of financial services in recent years. So slide rules have become supplanted by computers, supercomputers, maybe quantum computers soon. Financial centers across the world, you don't have the sort of roar of outcry, open outcry trading anymore. It's been replaced by the hum of computer mainframes. And traders and even portfolio managers are today less likely to spend their time hobnobbing with brokers and company bosses, and more likely to spend them buried in line after line of Python. High finance has become more about data than about connections. So the big question we're going to be asking today is how much of the hype is reality and how much of it is just hype. We're going to be talking about AI, quantum computing, decentralized finance, machine learning, Web3, although I think we might be onto Web4 or Web5 by now. And the big question we want to ask is how much of this is real? And for the real bits, how on earth do regulators think about regulating a landscape that's changing so rapidly? So enjoy the morning, and can I please invite the panelists for our first session to join me on stage. This is Navigating the Future of Finance in a Decentralized Ecosystem. And joining me, we're going to have Dalal Buhejji of the Bahrain Economic Development Board, Angela Johnson-Devet of Natwest, Jason Maude of Starling Bank, and Prashant Jajodia of IBM. So, Dalal, could we maybe start with you? So you work attracting inward investment to Bahrain's financial services sector. And maybe to set the scene, could I ask you to talk about how important is decentralized finance to you? And how much potential do you think it has to reshape mainstream finance?
Yeah. No, well, thank you so much for having me today. Obviously, we at the Economic Development Board are very keen to growing Bahrain's private sector economy. As you mentioned, we do focus on diversifying the economy, attracting investment. And the major sector that contributes to Bahrain's economy is financial services. We celebrated 100 years of banking a couple of years ago. So we do have a strong history when it comes to financial services. And naturally, seeing innovation in the sector is a natural transition. So DeFi, decentralized finance, is something that we have been seeing for the last few years. We know it's here to stay. But the important thing that we want to do is how do you regulate it? And that's kind of the main topic that we all discuss, is how do we welcome it, but make sure that we safeguard the users and the platforms. So the Central Bank of Bahrain has been monitoring the space quite heavily. They have launched a number of regulations to support the growth of DeFi. I'm not going to say we're 100% there. We're constantly evolving and we're constantly improving our regulations. But I have to say that we were the first country in the region to actually introduce crypto asset regulations back in 2019. And we did a second iteration amendment in 2023 as well. And we do have a number of players, 3 crypto asset platforms in Bahrain, 1 liquidity providers, and a digital bank that will be fully operational by year-end, catering to digital assets. So to answer your question, yes, DeFi is here to stay, and we're here to monitor it and to make sure that we have the right ecosystem in place to regulate it as well.
And I wonder, are there any sort of particular use cases of it that have really caught your eye that you'd like to sort of highlight?
I think we were quite lucky to actually have the Regulatory Sandbox introduced in Bahrain back in 2017. That brought in different kind of use cases as well on how DeFi can be utilized. We've seen different kind of fintech companies operating out of it, where we were able to see what the future could look like in the next few years. As I mentioned, crypto exchanges is obviously the first kind of platforms or use cases that we've seen in Bahrain, and maybe globally. That's the major trend, hence why we do have 3 regulated crypto asset platforms in Bahrain. But obviously, as with all what we've seen in the news, liquidity providers are quite important. Hence why recently, early this year, we have seen one liquidity provider operational out of Bahrain to support and to stabilize this sector. Digital banking is something that as well is quite important. And we have a Singaporean family office that actually is establishing a full-fledged digital bank, mainly catering for crypto asset and trade and asset platforms in Bahrain. And we constantly see other sectors. So I think these are the main key sectors, but we anticipate that's going to be growth in other verticals when it comes to DeFi in the region.
And I suppose one of the other major challenges for building this sector is, attracting the talent, the human capital that it actually takes to do it. It's in high demand at the moment all across the world. How challenging are you finding that? How big is the pool of people you can attract, and what do you need to do to get them there?
I think it's a global issue right now, attracting the right talent, especially when it comes to tech talent. There's a shortage globally when it comes to coders. Bahrain has always been strong with its human capital. We're quite proud with the talent that we have. Traditionally, we had a good number of bankers and financial experts, but now we're seeing the transition with coders and technologists entering the market. And I think the fact that we're a young population, our demographics are quite young, we do see a trend of a lot of students enrolling to STEM programs, which are being very qualified to enter into the new jobs that are requested by banks, financial institutions, and tech providers. And we do have the right upskilling programs in place as well to ensure that we have the right coders and technologists that are fit for the jobs in the future. And just a quick example of a use case is, for instance, City was looking at establishing a new tech hub in the globe, actually, and they were looking at different sites on where to position that. And they looked at Bahrain as part of other countries, including Israel, India, and Eastern Europe, and other countries. And they did rigorous analysis and testing and examination. And Bahrain actually scored quite high when it comes to human capital and talent. And the best part about it as well is the gender diversity. The women coders in Bahrain as well also contributed quite heavily and were scored quite high in these tests, hence why they decided to establish a 1,000 coder tech hub out of Bahrain in 2021, which we're quite proud of, and we are seeing different other organizations as well considering establishing different tech hubs in Bahrain. So yes, tech talent, or talent is important. You just need to make sure that you invest in it and you have the right programs in place to constantly bring in the right talent into the workforce.
That's really interesting and heartening to hear on women coders, I suppose, yet another reason, if we needed one, to encourage STEM education. Could we come on to exactly which new emerging technologies we're seeing that will impact the financial services sector? And Prashant, I'd like to come to you on this. We hear a lot about generative AI, quantum computing, Internet of Things. The list is basically endless. In your view, what are the most exciting technologies emerging at the moment that will actually reshape the financial services sector?
Thank you, and first of all, delighted to be here. You talked about the hype around technology, and no doubt there's hype around lots of technology. But equally, I have no doubt in my mind that technology has fundamentally transformed financial services, especially digital technologies. If you look at the most profound example is if you look at the crash the banking crash of 2007 versus the crash which happened earlier this year. In 2007, when Northern Rock, kind of there was a run on Northern Rock, the main pictures were long queues, miles-long queues for people waiting to withdraw money. In March 2023, this year, when Silicon Valley crashed, it crashed overnight and it was rescued over a weekend. That crash happened, the issues about Silicon Valley went viral on social media, and then with a click of a button, people withdrew huge amount of money, and it created a run on the bank, right? So just those two pictures are profoundly different, and the difference is digital transformation, how technology has completely changed, banking and financial services. Looking into the future, we at IBM, we feel that there are two technologies which will fundamentally change financial services in the next, let's say, 5 to 7 years, and those are generative AI and quantum. Generative AI, with the launch of ChatGPT in November, is the talk of the town. From children in school to grandparents at home, everybody is experimenting with Gen AI. People are using it, but I strongly believe that Gen AI will disrupt finance. I mean, there's already a lot of AI in finance, but if I just paint a picture of the future of public finance, banking, which we all do, I think in 3 to 5 years, we will all have AI which will look at our cash flow and kind of help us with our buy decisions, right? Whether I should buy my favorite whiskey, I should wait for the Amazon Prime Day or scan the market. I think AI will be doing that because they, based on the cash flow analysis, can do that. AI will probably look at, even before my insurance is about to expire, it'll scan the market and recommend the best choices for me. AI is already doing algorithmic trading, but for retail investors, in terms of what to buy, what to sell, recommendations based on your portfolio. So all of these things are very possible use cases. Some of them are already live, but with the power of AI and cloud, they will get mainstream in 3 to 5 years. When it comes to quantum computing gives you 100 million times more power than a computer today. And that power can disrupt financial services. Just to give some examples here, when you talk about fraud, most of fraud detection in banks today is batch. But with quantum computing, you can do real-time fraud detection. You can identify patterns faster than the fraudsters defraud the banks. So that will be a good use case. The obvious use case in financial markets, simulation, the Monte Carlo simulation to identify risk, pricing, that can be done much faster with quantum. But on the flip side, on the negative side, quantum will create havoc by giving hackers the power to decrypt data. Most of the encryption technologies of today, for example, if you take a standard RSA token encryption, it takes years for today's computer to break that. But with quantum, it can be done in days and hours. So, but thankfully, it's not all doom and gloom. There are quantum-safe encryption technologies, and over a period, financial services will migrate to those quantum-safe encryption technologies. So I think quantum and AI are two which will have a big power to continue to disrupt and make financial services more digital.
So AI advisors addressing the advice gap, maybe, and giving more people access to it, and I guess more doom and gloom on the quantum cryptography side. Jason, could I ask you just as important a question, and almost a more interesting one for me? What are the technologies that we hear talked about an awful lot, even with relation to financial services, that you actually think probably won't have much of an impact on the sector?
Blockchain, in a word, in terms of the level of talk versus the actual impact. I think it will be hard to beat blockchain for lack of return. Mainly because one of the big problems with utilizing blockchain in a way, and crypto as well, in a way that actually benefits the vast majority of people, right? That benefits people on a large scale, is this question that has dogged the internet since Napster was closed down by a judge. The story of Napster is that when Napster was closed down, their defense of the defense they presented in court against copyright infringement was, we don't have any music on our servers. You know, they're being brought up for copyright infringement, and they say, well, there's no music on our servers. We're just a network that helps share, you know, people share files. And the judge went, very clever. Okay, you're responsible for the network then. But there are bad actors on your network who are sharing copyrighted material. You have to go and shut them down, right? Now, given that 99% of what Napster was doing and was sharing music files and copyrighted material, they couldn't do that, and so they got shut down by the court order. So this has been the problem that has plagued the internet ever since. People have said, oh, we're just a network, you know, we're just a network, we're not a taxi company, we're not a hotel chain, we're not a publisher, we're not a this, we're not a that, we're just a network. And, you know, the question is constantly, how do you stop the bad actors sharing misinformation or abusing, you know, being abusive or what have you from abusing your services? Now, financial services cannot come along and say, we're just a network, because the regulator's response will be, like hell you are, you know, you are responsible for this. You know, if there is a mistake, if there is malfeasance, you will sort it out. But the whole point and promise of blockchain and crypto and so on is, we don't need that anymore. We just put our trust in the technology. As a software engineer, I am telling you, do not put your trust in the technology. I do not trust the code I write, so you shouldn't either. There have to be lots of checks and balances, right? There obviously has to be lots of double checking and triple checking. Software engineers make mistakes, and the best software engineers will put stuff into their systems to assume that they will make mistakes and then to correct them as quickly as possible, detect, correct, and prevent those mistakes. So any system that comes along and assumes that there will be no mistakes is not going to work. And, you know, the question, I've heard too many stories about people going, you know, I put my money in crypto and then I lost my password and lost it all. You know, the regulator will not accept the, you know, well, sucks to be you as a response from the, you know, the system in question, right? They'll say, no, you have to help consumers. How are you protecting your retail customers against this? So for mass adoption, I think that this is, we've hit the limit, I think, of where this is going to go without some drastic change. Now, there are some possibilities of how that can happen, but ultimately you need some centralized body in control who's going to correct the mistakes and the malfeasance.
I think that's very interesting. I think after last year and a rather large amount of malfeasance, linked to cryptocurrencies, we don't really need persuading. I think there's a rather unfortunate man still searching rubbish tips in Wales for the passcode to several $100 million worth of cryptocurrencies. Absolutely.
You know, which of these 1,000 USB keys that were thrown away is the one that will actually unlock my you know, nominally $1 million, you know, crypto investment.
Angela, so there's one technology we haven't touched on just yet, which definitely has the potential to transform all sorts of industries, and particularly banking, and that's machine learning. I wondered if you could talk a bit about how machine learning is changing how banks operate.
For sure. So I got involved, I studied machine learning back at university a very, very long time ago, but then got into it with the bank I was working at in 2017. And I remember in 2018, McKinsey said that AI and ML is going to be the next big thing. And I remember sitting there thinking, okay, that's pretty cool. And I waited in 2019 and I was seeing some things going on, but not a lot. 2020, 2021. And it was not until December 2022 when we really started to see AI and ML in anger with the release of ChatGPT. So then the financial services firms were obviously watching all of this and had to think, okay, how are we going to respond? We've had artificial intelligence and machine learning in our organisations for quite some time. Some of it's been built by us. Some of it's within the software that we're using, and that software could be software that is on our prem, or it could be in the cloud, or it could be software as a service. And that was a big question mark, because there's quite an amount of shadow software as a service that many of the firms had. So if there was artificial intelligence and machine learning in that software as a service, it too was shadow. So that was interesting. So trying to make sure that you've got a grip of where all of it is in your landscape, I think is really important. But then it's what do we do with ChatGPT? So an option is you make it available to your coders so that they can ask ChatGPT to build the next module that they need to code. Generally, this was not allowed, and there was two main reasons. The first one was one of the rules is that you can't negatively impinge the human rights of another person, and that was considered just too broad a term and condition for the banks to accept. The other one was that it had to be explainable, and again, as we all know now, ChatGPT hallucinates, which is very unexplainable. So that was not going to fly. But I think some of the organisations are certainly thinking about bringing large language models, generative AI, into their own firms so that they've got their own version of ChatGPT running in their own landscape. I think that's quite interesting. I think that with the machine learning and artificial intelligence that's being built in-house by the banks, financial service organisations, very important to have a methodology, to have controls, as you would agree, and also to make sure that you've got a log of where that is and that you can explain it. And I think those things are all very important. So, and even if you do implement your own ChatGPT, your own organisation's ChatGPT, again, that explainability, keeping track of where it's being used will continue to be very important.
And I wonder, this is moving, this sort of development is moving so quickly. You work for a large bank. It is naturally harder for big banks to kind of move fast and break things, and they're not allowed to break things. So I wondered if you could talk a little bit about what are the particular kind of challenges for kind of large institutions at managing to adopt this stuff?
For sure. So, I mean, I think the big challenge for most incumbent banks, you could pick any one of them, the big investment banks, the European investment banks, the American investment banks, British banks, the big challenge that all incumbent banks have is legacy tech and data. That is the big challenge. And I think all organisations around 2018, 2019, everyone was thinking, we'll just move on to cloud, and once we're on cloud, everything will be solved, and won't that be fantastic, and we should be able to knock that over in a couple of years. That's not what people's experience is. So you've got a couple of the big American investment banks are quoting that it's going to take them around 10 or 7 years to move the bulk of their estate onto the cloud. So that's quite some time whilst you're dealing with a lot of legacy tech and AI. There was one British bank, and I really need to check my notes in more detail, but they were saying it was going to take them 30 years. So it's quite a long time to be dealing with legacy tech and data. And the challenge with that is not only do you not get the benefit of moving to the cloud, and the benefit is, as an engineer, as engineers, we really love the cloud because it means that we don't necessarily have to take everything down on a weekend and give up all of our weekends to do a deployment. We should be able to do an automated deployment on a Wednesday, as an example, or intraday if we wanted to. So there's a lot of advantages to the engineers. It is, in theory, cost effective, although that's not something that the banks are necessarily being able to achieve at the moment, but there is definite benefits. And the next benefit is data. So one of the advantages to having everything in modern architecture and not having any legacy tech or data is that you can really take advantage of your data. You can adopt artificial intelligence, machine learning, at pace, and you can leverage the AI and ML because you don't have any legacy tech and data, and you can do what's called virtualization, where you leave the data in the location where it exists, you bring it in when you need it, stitch it together, run your analysis off it, and then let it go. That particular technology is not something that is really available if you've got lots of legacy tech and data, because as soon as you build the virtualization and then you move on to a piece of modern technology, the old technology obviously is redundant and out of date. And potentially unusable. And I think the interesting thing that I'm seeing at the moment is, data mesh, X analytics, which is this sort of virtualized data solutions, was very much a dirty word for incumbent banks which have lots of legacy tech and data. What I'm now starting to see is actually it's not that bad, and maybe we should just run with it anyway, even though we may have to decommission this at some point once we've got resolved the legacy tech and data problem. So I think fix the legacy tech and data, and then you can use the data in anger, and in the meantime you might want to look at either a data lake or potentially virtualization, but consider the fact that you may have to decommission it at some point.
So you need to do stuff that you might need to decommission in the name of in the name of keeping up.
Totally, but the business case behind it might stack up and outweigh not just the build of it, the run of it, but also the decommissioning of it. And if that business case does stack up, then there's obviously a business case for doing
Go
it.
ahead, it's not wasted work, right?
Yeah.
Prashant, could I come back to you on a topic that's in the title of this salon, but we haven't got to yet, which is Web3. And I have heard people talking about Web 4 and Web 5 as well. I'm going to confess to some bafflement over exactly how that could be useful within finance, and I'm hoping you can enlighten us.
Yeah. We in technologists, we like to put a version number to everything, right? So my favorite news item from last week was about Justin Bieber. I don't know if anybody tracked that. Justin Bieber bought a NFC, Bored Apes digital token in November 2021 for 1.3 million. And last week, the value of that token number 3001, was $59,000, down 88%. So, yeah, as Jason mentioned, and you touched upon in the beginning, there's a lot of hype around blockchain, cryptocurrency. It is certainly past its hype curve. But my view is they're here to stay. Web3 technologies, blockchain, cryptocurrency, smart contracts, whatever you call it, they're here to stay. And before I dive deeper into it, I think if I just paint an overview, obviously, we all know about Web3. We have heard of all these terms. But what exactly is Web3, right? So Web 1 was the internet when it started. It was a read-only internet with static pages. The technology which enabled it is World Wide Web, or Hypertext Transfer Protocol, HTTP, as we all type it on the browser. Then came Web 2, which was read and write, which is with the platforms like search engines, social media. You could interact with it, you could post and share stuff on it, and that led to the rise of big companies like Google, Meta, and TikTok, etc., etc. But it was great for people, but the concern was that these companies were growing in power, they were dominating the internet, and your data, you don't own it. These companies use the data to make money. That was the concern, and that kind of led to the birth of Web3. Web3 is basically about read, write, and own. So that's the concept behind Web3. You can read, write, but you own your own data, right? It's decentralized. The fundamental technology behind Web3 is a distributed ledger. Distributed ledger allows you to, the data is in distributed nodes, and it's not owned by anyone. And the changes to data is visible and seen by everyone, right? So I think the technology fundamentally is quite sound. And that technology, it's led to, a lot of innovation, things like cryptocurrency, smart contracts. A lot of innovation, has happened at the back of it. Obviously, there is, like any new technology, it goes through a hype cycle, and Web3 has gone through the hype, and a lot of issues, malfeasance, all of those things. I think there are a lot of negative, issues around. There are other things which has prevented adoption of Web3. For example, it's not simple to understand and use. There are a lot of complicated terms and things like mining. I don't know what the hell is mining in computing, right? But there's mining, there is tokening. It's very technical, and it requires huge amount of compute. It's not environmentally friendly. So there are, and of course, the lack of regulation and all that is led to Wild West. So all of these things are the issues, but a lot of these issues are getting solved, right? With Ethereum now moving to a different protocol, it is much more sustainable. There's a lot more regulations coming in. A lot of central banks some of the central banks, you talked about Bahrain Central Bank. A lot of central banks are thinking of, having their own digital currency, right? So my belief is that crypto will continue as an asset. There are people who want to invest in it, will keep in it. Some people are predicting that it will go up. The value came down to $1.3 trillion. The market cap of crypto is now $1.3 trillion, down from $3 trillion, a year back. Now, whether it will go up or not, I don't know, but it's here to stay definitely, because you can do a lot of innovation. We at IBM have used blockchain technologies to do lots of innovative things like vaccine distribution, tracking, supply chains like food, source of food, freshness of food. In finance as well, trade finance is a very key use case. So new use cases will keep coming, especially in business to business, because whenever there is a business to business exchange of value, you need an intermediary, and blockchain is a way to kind of reassure that exchange. So I think Web3 technologies will continue in future. To your question about Web 4 and Web 5, well, these are more fads, more new-fangled ideas. But like Web 5 was launched by Jack Dorsey a couple of years back. It is, the point here is that Web 3, some people claim that it's not really decentralized. It's owned by the venture capitalists. So Web 5 is going to be much more decentralized. You can use digital identity, which is a very good concept in Web 3. You use digital identity. Just hypothetically, you can use a digital identity to open a profile in a social media without registering your profile. And if you post, and share stuff on the social media, on a Web 5 social media platform, that data can remain in a node which is owned by you and not by the social media platform. So that will be like Web 5, but it is just a concept at the moment. Whether it will be reality and how it will obviously go through its own hype curve and all of that.
Thank you. And Jason, I think you might describe yourself as a bit more of a skeptic on this, and you already talked a bit about blockchain. Is Web 4 and Web 5, or to use a more prosaic example, smart contracts, are they the future of finance?
So, it all comes down to this. Ultimately, the problem is you can't remove humans from trust, right? If you're going to sign a contract, like the two people or organizations signing the contract with each other have to trust each other and have to trust that if the contract goes wrong, there will be intervention. And it doesn't matter whether you put that on a smart contract or carve it into a stone tablet. It's either way, you've got to have trust between the two parties and a way to get out of doing something wrong. I think the problem with Web3 and then the future things is, as you said, it's about ownership, right? Ownership of the data. The problem is that what does that mean, ownership, right? If I put money into a bank, if I deposit money into a bank as a retail customer, that's my money, right? My money which I have given to the bank in trust. So the bank is holding that money for me, right? And it is also holding my data for me, my financial data, right? It's holding that in trust. Now, technically, I own this, but I don't have the power to maintain it and manage it myself. I haven't coded the systems on which that data is being recorded or maintained. I do not own the depositing or the payment systems which are being used, right? So I don't have the power, so I have to trust this other organization to do it for me, and I have to have a way of intervening if it goes wrong. And I think that the problem with all of the decentralization is the thing of like, if I lose my password, if there is a mistake in someone fat fingers or the number and puts an extra 0 on the end of my payment or what have you, anything like that, and this can happen with computers just as much as it can happen with humans, and with computers it can happen far faster. Who do I pick up the phone and call? Who do I chat to? Who do I get on the phone and so on? And that's the problem is I can't pick up the phone and say, get me the DAO. Bring the decentralized autonomous organization so I can talk to it. And that's the problem, right? You need to have someone you can talk to, someone who can intervene on your behalf. And that's what is missing here, right? It's the ownership of my data, ownership of my money is fine to talk about in the abstract, but unfortunately I'm a software engineer. And the question I will automatically ask is, well, how does that actually really happen, right? What really happens when something goes wrong? Not if something goes wrong, but when something goes wrong. And this is why resilience is becoming a much bigger thing for all of the regulators. They're stopping asking, how do you prevent things from going wrong? Because, you move fast and break things, but you move slow and break things. Movement causes things to break. And the regulators want to know, the customers want to know when things break, not if things break. How do you correct that problem? So that is why I'm skeptical of all of the stuff that talks about ownership and decentralization in this way, because ultimately things will go wrong and someone needs to fix it. And if someone needs to fix it, someone needs to pay someone to fix it. Who is doing the paying? Who is doing the fixing? Who is checking up on both of those?
Yeah, you ultimately can't kind of automate or decentralize away what is fundamentally a human activity, and finance is a very human activity. I think that quite neatly brings us on to how you think about regulating all of these new activities. And Dalal, you talked at the beginning a little about how Bahrain is thinking of regulation, the sandbox. I wondered if you could sort of give me a little more on just how you think about the pace of change and what you need to do to regulate it.
So just following on the conversation, DeFi is here to stay, and this is the future of finance. And to us, it's all about understanding it and having the right infrastructure in place and the right regulations to support companies to thrive and to also protect consumers. Our regulator, Central Bank of Bahrain, constantly is in dialogue with these platforms, but also is in dialogue with the users. Any new regulation that comes out to the market will have to go through industry consultation, where they actually gather the feedback of the industry to understand whether the regulation works or not. That being said, though, once the regulation is out, it doesn't mean that it is there to stay. It is there to be amended, and it's there to be changed as things develop and change. But we understand that this concept is here to stay, and we want to make sure that we safeguard it and try to regulate it as much as possible. And I think the fact that it goes back to that we have a single regulator, so it makes things much easier, where you're just reporting to one single regulator that actually monitors the whole market, but also goes back to the size of the market. We are small, which works to our advantage. We act fast, we're nimble, so we're able to mitigate and amend things quite rapidly, which is why we've been very successful with introducing a number of regulations, whether it's open banking or it's the crypto asset, the amendments of both of these regulations. But yeah, I mean, we can't say we're here to understand it all and we're expert, but we're here to acknowledge it and understand that it's here. We try to have the right balance, not to, as you mentioned, having the cowboys in the sector, but making sure that we welcome it with some care and having some sort of regulations in place.
Thanks very much. And Angela, banks think about regulation almost as much as regulators themselves do, and there's so much to navigate here in kind of conduct risk and data usage and usage of the cloud. How are you thinking about the sort of changing regulatory landscape?
Sure. So I think with the new technology, everyone's learning, and that includes the regulator. Okay. And I think with the big global banks, the challenge that they have is that they don't have just one regulator. They have a regulator for every country that they've got data in. So that could be 50 or 70 regulators. And then some of those regulators are very difficult to comply with, some of them are less difficult to comply with, and some of the regulators will create regulation which is the exact opposite of other country regulators to try and dissuade folks from being in both countries. So that's difficult. So I do think that just understanding what everybody wants and then complying with it is quite an effort. And I would say that some banks might look at some countries and just think, you know what, that's just too difficult. We'll just stay on-prem and we won't move to cloud for that particular country because it is so difficult. Or we'll invest in a whole new cloud solution for some countries because they do want to be in the cloud. And frankly, the only cloud solution that they can be in is one that's specific to that country. So I think that's all very interesting. I think the way in which the regulation change is funded is interesting. Sometimes it's off the back of a fine or a Section 166. Sometimes it's a new regulation that's come out that just needs to be met. So I think that's interesting. The way in which the regulation change is then delivered is also interesting. So sometimes you've got a regulatory specific program. Other times you've got a regulatory initiative which is an ask to each of the delivery managers across the bank, and it's more of a big borrow steal from everyone that's there. So I think that's interesting as well. I think with respect to cloud, I think that the cloud providers, so at the moment it's the banks that are regulated about what they're doing with cloud, but I think the next step is that potentially the regulators might start talking to the cloud service providers themselves and potentially regulating them. And I know that some of the cloud service providers are preparing for that. If, for example, and it hasn't happened, and I don't see it happening, in the near term, but if, for example, all the banks started using ChatGPT in anger, all of them, you could say that obviously the regulators will be trying to regulate the use of ChatGPT, but they may also start thinking about, well, perhaps similar to the cloud providers, maybe ChatGPT is a provider that they might want to start regulating as well. So I think all of that's something to think about. And then where's it all headed with the latest in technology? So I think if you think about what is technology doing to us as individuals, and what is it doing to us as a community, and what is it doing to us as companies? And if you can see that, so Forbes says, it's unlikely that all of the truck drivers, when we get autonomous vehicles, are going to become AI programmers. It's more likely that they'll potentially not have a job, which means that the rich get richer and the poor get poorer, and that's definitely something that Forbes is saying is going to happen. And then for us as individuals, my daughter, I hate to think about it, but she's never going to have to work out how to chat up some person at a bar. She's just swiping left and right and finding her future spouse. So all of that is impacting us as a society, it's impacting our companies, and it's impacting us as individuals. And if we can see it, our Prime Minister can certainly see it, and I think the regulator can see it as well. And I think that's what's going to be interesting, is what is the regulator going to do about all of these things that are impacting us on so many levels. And then I would advise for financial services institutions to get on the front foot and think, Google had a motto which was "Don't be evil." Maybe adopt something similar and just make sure that you're using this latest technology in an ethically or an ethical way. And I think that would be a good advice.
Yeah, it's fascinating, this sort of shifting boundary between finance and big tech that's sort of starting to resemble the shifting boundary between big tech and the rest of our lives, as you're touching on. 100%. Now, we have a few minutes for audience questions, so could I invite anybody who would like to ask one to raise your hand over here?
I guess I'm asking my question to Prashant. When we talk about when we talk about blockchain, we mainly talk about an encryption protocol and the distributed ledger concept. And once quantum computing arrives, we can still have, or we will still have, the distributed ledger concept, but the encryption protocols, the existing algorithms for today's blockchains are in great danger. Is that true?
Yes. So the algorithms which we use today, like the synchronous, asynchronous, mainly the RSA, encryption methodology, those algorithms can be broken by quantum. I mean, way back in 1994, a scientist called Shor proved it, that using his algorithm, if you had the compute power of quantum, you can break these encryption technologies in the matter of hours and days. So they can be broken, but there are new algorithms already available. There are algorithms like hash. There are different kinds of algorithms which are already proven. NIST, which is an agency which governs all sorts of security algorithms. They have run various competitions. We as IBM have participated in that. So these algorithms are available, but there has to be a migration of from the old encryption to the new encryption. And you think of it like if I draw an analogy, think of it like a Y2K problem. A lot of people, the coders, have to go and look at the code, and every time there is an encryption, they have to move from the old algorithms to the new algorithms. The other consideration is data. So quantum technology, depending on who you ask, this kind of technology will be available maybe in 5 to 7 years, in much more much more widely. So there could be bad actors who can actually get your data now, store it, and in 5 to 7 years, when this technology is available, use it to decrypt. So you actually need to start thinking of critical data now and make it quantum safe.
Thanks very much. We have a question over here.
Very interesting conversation. Very good to see the different perspectives. So you're describing an industry that is transforming. You're having this technology that is going at the core of it. And we have some incumbent players that are doing some stuff. And we discussed how it's difficult for them to change because of the technology structure and so on and so forth. And then there's new players that are coming in with interesting technology that goes all the way from just doing what the banks were doing, but doing it or doing something completely different. Now, it seems to me that we're looking at a space of complete confusion and complete interaction of entities. Now, we have the incumbent banks that dominate the industry. We have these new challengers coming in and doing some interesting things. Then we have the regulators, and then we have big tech. Who's going to win at the end? And is it going to be, are we going to see one single winner, or are we going to see collaboration across the board? And if so, how do we drive this collaboration?
Who'd like to volunteer?
Predictions are very difficult, especially about the future. Who's going to win is a difficult question. I think what we're going to see is we're going to see increasingly a split between banks who want to be banks, right, and who don't want to, who outsource most of their technology. We're going to see technology providers, and we're going to see some who are both, right, who are both decide that technology is their core competency, is a core competency, and they are a bank. So we're going to see this increasing, I think, move away from some of the big players who say, you know, we can't handle technology ourselves, and we don't want to, and they will increasingly move away from that, I think. As it becomes more and more complex, because technology shows no signs of slowing down, and you know even now, big banks saying we're going to invest in AI and ML, and you're sitting there going, you can't even get two of your databases to talk to each other, and you've got a COBOL server, you know, in the basement, right, you know, running COBOL code that was written by Dave, who is now retired, and no one else knows how, you know, what it does, but you can't switch it off because it makes you millions of pounds a year. You know, this sort of situation is unsustainable, and I think that banks will, you know, a number of banks will say we are moving out of the technology space, or they will say we are going to try and completely transform ourselves and turn ourselves into a technology organization as well. But I think that decision point is coming rapidly down the road.
And I mean, what I'm certainly seeing is that, I mean, you've got the challenger banks, where Jason's from, so doing extremely well. I think most of the incumbent banks, such as my bank, are starting to say, actually, we have to be technology companies. We have to be. There is no option, actually. We cannot stay just being banks and keep the CIO off to the side, reporting into the CFO. Those days are gone for pretty much every company, and definitely for banks. So I think that the CIO is being lifted onto the board. Technology is ultimately being promoted within banks significantly, as is everybody in it, which is fantastic for me because I'm in technology. And I think it's a really exciting time. But there may be some banks that decide that they don't want to be technology companies, but more and more I'm seeing we're a technology company first and we're a bank second. Back to the big tech, that's interesting because like Apple's got buy now, pay later. Like a lot of big tech is starting to dip their toe in the water. I remember, it's frightening a little bit, but I do remember a while back, you know, when is big tech, thinking to myself, when is big tech going to offer something like Dropbox? Back in the days of Dropbox. When is Apple going to have a Dropbox, do you think? You know, where's Google going to have a Dropbox? Well, they all got there. And it sort of feels a little bit the same. It's like, I wonder if Google's going to become a bank. You know, I wonder if that's going to happen. And it's a great question.
I think my view is that the consumer will win, and the rest of us have to collaborate.
I think, just to add on to what you said, the idea of the CIO or CTO reporting into the CFO is really funny to me, and would be really funny to anyone at Starling Bank. It's just hilariously outdated.
I think we have time for one more question over here.
Thank you. Hello. Good morning. Shabir from International Finance Solutions Associates in London. I've got two quick questions. One is to the panel. With the technology and sort of the concept of digital nomads now sort of becoming very sort of operative in the whole industry, and there are certain countries which are facilitating, if you like, visa requirements. The issue that sort of becomes interesting within that is, you know, if someone breaks their leg at home, Do they get compensated by the employer who is employing them? And issues of that nature, which will make more complex the whole idea of working in a different country. Tax regulations, employment rights, all kinds of issues arise out of that. That's one question. Secondly, specifically to Dalal, is with the competition from Dubai and Saudi, how is the financial services sector? I know Bahrain has had a long history of having regional headquarters in Bahrain, but as you know, Standard Chartered moved to Dubai, and there have been other sort of issues. How's Bahrain coping with that?
Perhaps we could take that second question first.
Sure.
Dalal.
So obviously the region is booming. There is definitely an economic growth in the region, and we believe that it's a win-win for everyone. We don't see it as a competition, more of a collaboration. There's definitely a lot of spillover effect as well, where certain companies can establish a presence, for instance, in Saudi Arabia, where certain functions as well can be catered to Bahrain. When you look at fintech specifically, or financial services, innovation in financial services, you can't really limit yourself to one country. The region as a whole should be considered when entering, hence why it all depends on the business model that the company has in mind, establishing a presence in Bahrain, utilizing, for instance, the regulation, the talent, the cost of doing business, and then catering your solutions to the wider MENA region or GCC region is what we are seeing. So those are mainly the trends that we're seeing, but there's definitely a lot of collaboration in this space. And again, it goes back to my earlier point that we understand that innovation is here to stay, and innovation is here to be utilized across all markets. And it's just a matter of what exactly can we offer to such companies.
I'm finally in the market for a very quick answer on a very difficult question, how companies should think of this world of decentralized human capital and the responsibilities they owe to digital nomads living. Would anybody like to tackle that in 30 seconds?
And how it relates to our current system of the nation state. And in 30 seconds, no. It's definitely going to, how technology interacts with social, and economic and so on, and governmental institutions is definitely going to become a big question, but it's going to take decades and decades and decades to resolve.
What a good place to end. Well, can I ask you to all join me in thanking our panelists for a really stimulating discussion? So now we have Nikhil Rathi, the Chief Executive of the UK Financial Conduct Authority, and he's joining us for a speech on regulating future finance, bridging the gap in the digital space, and we'll have a Q&A afterwards. Thank you so much.
Thank you, Josh, and morning, everybody. And it's great to be here, and particularly the work with the Bahraini authorities, which we at the UK Financial Conduct Authority very much appreciate. We see that Bahrain is really transforming into a data, digital, cloud hub, and look forward to building that cooperation. This morning, I was going to say a little bit about our emerging approach to AI, digital regulation, big tech regulation, as it applies to financial services, and then look forward to all the questions from Josh and the audience. AI, huge topic, and depending on who you speak to, this could be the end of civilization as we know it, or a cure for cancer, or both. A lot of anxiety about jobs that it might displace, but also the opportunities for really dramatic shifts in productivity. From our perspective at the FCA, we want to embrace this innovation, but just make sure the right guardrails are put in place. And that's really consistent with what the UK Prime Minister has said in terms of making the UK the global home for AI safety and regulation. A lot of this work is international, it's collaborative, so we partner with around 97 regulators around the world as we think through these issues, and it's interconnected with the work that we do on big tech. So today, we're publishing a feedback statement on some work we've been doing about the future of big tech in financial services, and in particular, having tested the market, we're announcing a further call for input on the role of big tech firms as gatekeepers of data, and the implications of that ensuing data sharing asymmetry between big tech firms and financial services. We think that's going to be a big issue for us to focus on going forward. We're looking at the risks that big tech may pose to operational resilience in payments, retail services, financial infrastructure, and the risks that big tech could pose in manipulating consumer behavioral biases. So that will be our focus of work in the immediate future. We see that there's a number of partnerships being announced, some just overnight, and those partnerships can offer great opportunity, but might they also restrict competition and introduce significant risks to market functioning. So that's something we're also going to be very vigilant about. So for example, if some of the big tech firms have access to unique and comprehensive data sets such as browsing data, biometrics, and social media, coupled with anonymized financial transaction data, this could result over time in a longitudinal data set that is simply unrivaled by any other type of firm. We will be regulating soon, subject to various bits of legislation, big tech firms as critical third parties, particularly given that over 2/3 of companies use the same small number of providers for their cloud data services. And that's going to enable us to be very focused on determining where responsibility lies when things go wrong, principally with the outsourcing firm, but there may also be systemic impacts from some of the critical third-party service provision. And we'll be doing that with the Bank of England, our colleagues at the PRA as well, setting standards for those services, including AI services. Another part of our role is in relation to markets. We have a responsibility for managing the integrity of markets. We run some of the largest global wholesale markets in the world here in London. And there are potentially very significant benefits that AI brings to those markets, but there are also significant risks to integrity, price discovery, transparency, and fairness. Misinformation fueled by social media can have very big price impacts on price formation across global markets. In May, we saw generative AI having an impact in US markets with an image purporting to show the Pentagon in the aftermath of an explosion, spreading across trading floors and having an impact on global market prices until US officials came in and made very clear it was a hoax. We've observed how intraday volatility through our own research has doubled since the 2008 financial crisis. We see trading firms increasingly looking to automated trading strategies. So all of those create new risks, potentially new systemic risks for market, as well as potentially offering benefits to market functioning. In the more consumer investment space, just last week, an online scam video used a deepfake computer-generated image of respected personal finance campaigner Martin Lewis to endorse an investment scheme. Very persuasive, and that shows that just as we look at the opportunities, the risks of fraud, cyber attacks, identity fraud, the scale, sophistication of those risks are something that we haven't had to contend with before. So as we regulate for a new use of this technology, we are going to be very vigilant about those risks and quite robust on the investment in managing those risks also going up at the same time so we can take the full advantage of beneficial innovation. Another area that we're looking at, and maybe it came up in earlier conversations today, is explainability of AI models. When we boil a cup of tea and we see how the boiling water over the tea bag produces that great cup of tea, we don't think about Brownian motion. We don't think we have to explain how that's all worked. And some would say to us that when it comes to AI and the models, that should be our approach as well. And we're really thinking this through. I don't think we have a definitive position at this point in time, but we have to be mindful of some of the biases that can arise in these models. So in New York courts in the last few months, there was a very famous case now where a lawyer referred to case citations that they had researched from ChatGPT, and it was entirely fake. And that the judge called that out. It's hallucination bias is the term of art for it, but it was just fake. We see problems around data bias. AI models rely very heavily on the accuracy of data inputs. But what happens when those data inputs are wrong or skewed and generate a bias? We also know, though, that human decision-making isn't perfect. Not so long ago, female applicants for mortgages were less likely to be accepted than male applicants. there are other challenges when it comes to decision-making on investment, and human decision-making is sometimes beaten by some of the autonomous investment decision-making made by algorithms that we see increasingly deployed. So this is going to be an interesting area of debate for us. There is a lot of speculation in the US that a very large set of firms is going to unleash entirely automated investment decision-making, not just trading execution, but investment decision-making. Although, interestingly, in China, recently a firm said they were going to do that, but then pulled back from it at the last minute. So maybe the market isn't quite ready yet. But almost certainly this is going to come our way. And then there's going to be a question for us as to how do we engage with consumers and make sure they understand the products they're buying when it's entirely autonomous, computer-driven decision-making. We're having a big debate in the UK at the moment about economic growth, supply-side reforms. We have had some very weak growth in productivity over the last decade, and there's some optimism that AI could boost that productivity, optimism that's been galvanized by some research in the US, suggesting that productivity was boosted by 14% when over 5,000 customer support agents used an AI conversational tool. Just one example of how the world of work could change and how there'll be entirely new jobs in the future. Other benefits we see in financial services, generative AI and synthetic data to help improve financial models and cut crime. Tackling the advice gap. We have a huge advice gap. Consumers don't focus sufficiently on their financial well-being. It's very expensive to do so for some customers relative to their overall wealth. There may be opportunities with AI-based models to really operate at scale. I was in Edinburgh a couple of weeks ago speaking to some startups on the Edinburgh fintech scene, a really interesting startup using generative AI to engage with very vulnerable customers who are at risk of bankruptcy because of their debt issues, but maybe too embarrassed to seek help, but able to interact with the generative AI application to take away the stigma and actually find viable debt solutions. So there's also the ability to hyper-personalize products, particularly in the insurance market, and tackle fraud and money laundering. So we want to capture as many of those benefits as we can and as quickly as we can. So from a perspective of a regulator, we've said we want to be a data-led regulator as much as a financial services regulator. That involves us investing really heavily in our own data infrastructure, our own capabilities, thinking about how we retrain our entire workforce to be able to think about how we regulate financial services in a completely different way. We have to invest in our horizon scanning and synthetic data capabilities. We have established a digital sandbox operating now around the year, the first of its kind used by any global regulator, using real transactions, social media, and other synthetic data to support fintech innovations safely. We cooperate in the UK with a number of other regulatory partners through our Digital Regulators Cooperation Forum. So we all have our different objectives. We as the FCA, the communications regulator, the privacy regulator, the competition regulator. But with the flexible regulatory structures we now have, we can think about how we're going to regulate together and make sure that there is coordination and join-up across the different functions that we have. We're thinking about where responsibility should lie. And I talked about critical third parties earlier. There's also a question about responsibilities for the models and the outcomes. Where very quickly the political debate in financial services turns to where does compensation or redress come from when something goes wrong? And that's a societal debate that we need to be having as more and more of these models come to the fore. Do we need to rethink models of consent? If a consumer wishes to consent to using a particular AI application, knowing that the risks may not be fully understood. So we want to think about how regulation can support that innovation, be proportionate enough, but also make sure consumers are well informed and well educated. And this is something that's coming upon us now. So we're having to make these judgments almost on a daily basis. We see AI-led business models coming through our authorizations gateway on a continuous basis now. We supervise 50,000 firms across the United Kingdom. So new firms coming in with new business models and existing firms looking to change how they operate. We have moved fairly significantly in the last few years, and particularly over the last year, to a more outcomes-based approach to financial services regulation. We have a consumer duty coming into force this month, which stipulates that firms must design products and services that aim to secure good consumer outcomes, and they have to demonstrate how every part of the sales of the supply chain, from sales to product distribution, delivers those outcomes. That's alongside our long-standing senior managers regime, which allocates accountability. And we think that, for the time being, those two frameworks give us enough to allow innovation into the market with some proportionate protections. But the debate won't end there. So there have been suggestions in Parliament recently that we need to put in place a bespoke senior manager type regime for AI officers who are responsible for the development and management of those systems and models, and they should be subject to additional regulatory scrutiny. And that's going to be an important part, I think, of the future regulatory debate, because those individuals will be increasingly central to firms' decision-making. As we do all this, we'll want firms to invest further in cyber risks and fraud risks. We will focus, as I said earlier, on the risks to competition. We'll be working with the Information Commissioner's Office to test consent models so that consumers understand risks and they are properly understood. And with the Financial Services and Markets Act just passed in the UK, we have a new secondary international growth and competitiveness objective, and making sure that innovations like AI are approached open-mindedly here in the UK is a core part of our work to deliver that objective. The UK is already a leader in fintech globally. We're in the top 3 centres in the world, #1 in Europe. We've got strong universities, a really interesting mix of talent here in London of both financial services, big tech, and professional services. So we think that gives us a good basis to really test some of these innovations. So thank you very much. Josh, I'm over in your hands now for any questions. Thank you.
Thanks very much. Gosh, you covered a lot of ground there. You raised an awful lot of things.
It's The Economist, so I have to.
Love to pick up on it. Maybe we could start with actually the final point you raised.
Yeah.
Which is this kind of interesting balance between encouraging firms to experiment, to innovate. I guess another way of saying that is to take risks that might go wrong, and protecting consumers from those risks. And you mentioned the FCA sort of incoming objective to promote growth and competitiveness in the UK. Has that objective changed the way you think about that balance at all?
Well, it's literally just come in. So you're talking. It's arrived just in the last few days. And I think that, I would think about it in a number of different ways. Firstly, when we talk about competitiveness with firms and what they say about regulators, they don't always say nice things about regulators. And when they're complaining, the thing that matters most is our operational effectiveness. Are we able to do our job swiftly, with clarity, with certainty, and with predictability? And so I think, firstly, the use of technology generally, but increasingly AI, can play a very significant part in our own operational effectiveness. We're using it now to tackle financial crime. We're using it to test sanctions compliance. We're using it to triage cases that come through our door. We're using it to interrogate sometimes 1 million pieces of evidence that we have for some of our complex enforcement cases. We're looking at how synthetic data can be used, partnering with telcos, with banks, with other regulators to look at fraud typologies. So that operational effectiveness, I think, is core to our competitiveness. Secondly, to me, there's 2 things. One is open-mindedness to innovation. And I think we have always sought to do that. We set up the sandboxes here. We lead the global financial innovation network of 80 different regulators around the world. And to provide the infrastructure for these innovations to be tested before they're rolled out. And we're very, very focused on trying to do that in an as efficient way as possible, focusing on the highest impact innovations. And we've seen several hundred firms, having gone through our sandboxes, then go and launch into market, and it's been a smoother path for them than otherwise. So that's how we would approach it. But this is, I think this is going to be a conversation that we're going to have to having continuously, because this is very disruptive, and we're open to feedback from the market as to how we should adjust adjust our approach while making sure we maintain the protections that are core to our objectives.
And yeah, as you say, there's certainly not a simple answer on that. You also raised the advice gap, the so-called advice gap, and this is absolutely vast. You know, the number of people who have not taken, who don't feel confident in investing their own savings, but who haven't taken any advice for it. And obviously, AI gives quite a lot of potential to address that advice gap because there simply aren't enough human financial advisors in the UK to do it at the moment. But how do you think about, when using a technology like that, which consumers are pretty unlikely to fully understand, how much do firms need to educate them on the risks of using, say, an AI financial advisor in order for them to be able to consent to those risks? We're all getting more familiar with ChatGPT and hallucinations, for example, but it's a little bit more dangerous, I suppose, if a robot financial advisor makes hallucinations.
Yeah, and I think that, look, there's going to be different stages of innovation here. So there may be certain innovations, for example, AI-based advisors, that we will only allow into the market for sophisticated investors, first and foremost, where there is a disclosure, there's consent, but you're going in with a portion of your portfolio to an autonomous investment vehicle or whatever it might be, and you're sophisticated enough to know that this might not work out. So there may be, I think there's going to be a path here before we would allow something like that completely into the mass market. And then I think we are thinking about leaning on our, particularly on our outcomes-based regulation. So we can think about allowing it in, but there needs to be strong governance, strong data, which is looking at the outcomes, looking at whether there are biases in the way the models are operating, and clear accountability for acting in firms should anything like that emerge. So our inclination will not be to try and hold back the innovation, but to be quite rigorous about the governance and controls that a firm has in place around how that's operating.
Now, that's really interesting, because examining biases, I guess you mentioned outcomes-based regulation there, but kind of examining biases and decision-making within some of these technologies, thinking of black box ones such as AI or machine learning, it can be quite difficult kind of, even for the designer, to kind of back out the reasoning behind doing certain things. And as we're seeing sort of more decisions being made over advice, more decisions being made over sort of execution of trades and which trades to do, how do you think about regulating black box technologies like that?
And that's with us, particularly in the trading environment, as you're having systems that are beginning to be able to learn and recode trading algos, and not necessarily you're not necessarily able to draw out a clear explanation afterwards as to why certain pivots have been made in the trading strategies. I think first of all we will want to know that these systems are being used. We'll want to understand what the mechanisms are to switch them off if there are concerns. We will need to we are going to be doing some studies, not just us, but with partners around the world, into what are the systemic risks. Because if one firm is doing it, it's one thing in the markets. But if you've got very significant correlated risks of tens of billions of dollars, potentially moving markets extremely disruptively upon certain triggers, that's a whole new world. And at that point, I think we would want to be quite vigilant and intervening. The reason I made that rather lame comment about a cup of tea is, I think we're probably going to struggle to require 100% explicability. This technology simply isn't going to provide for that. And we aren't going to be able to audit in the traditional sense that you may be able to audit algorithmic models. So this monitoring of outcomes and the guardrails around intervening when risks are crystallizing, I think, is going to be a big part of the conversation, but also a societal debate about there are incredible benefits of this technology, but we probably are going to be introducing more risk in different ways into the system, different types of risk into the system. And to what extent is that going to be societally acceptable? And we may well find that different jurisdictions with different cultural predispositions have different approaches to that question.
And on the same point, sort of on the kind of conduct risk side, there is also a line, isn't there, between at what point does analysis of kind of huge data sets allow you to kind of work out things that we might previously have considered to be insider trading? If I have a bunch of satellites following a manufacturing plant or something, I might be able to predict through sort of brute force of analysis of the data completely unexpected things like the board is constantly fighting with each other or something like that. At what point, and you know, so some of the big tech firms do have vast enough data sets to really allow quite unexpected things to be kind of inferred. Where do you think of the line between those things?
So our general approach is where information is public, if a firm has invested in capability that enables them to interrogate that information faster than a competitor and is able to trade on the back of that public information, that's fair play. That's a competitive advantage in a market system. It gets much trickier when you're talking about private information. But I think we probably want to hold to that boundary to the extent that's possible. The next phase, though, and why I mentioned that deepfake image in the US, is, and this is more traditional manipulation, but it could be harder to track. When someone puts out something that is false, that is market moving, very hard to track potentially. I'm not going to comment on a particular case, but very hard to track what the origin of that false piece of information is. But then there are others who have then traded on the back of it, and even a small, couple of decimal places move in the markets, you can make a lot of money on the back of it. I think that's going to be the big challenge for us as markets regulators around the world, because these are global phenomena. And we'll want to be quite hard and tough on that, but that will mean that we will need to tool up. And it's not just financial regulators. It's going to be, that's why we're working with our communications regulators, other regulators around the world, because sometimes these are phenomena that cross sectors to make money. And the final point, which moves away from the insider trading question, but one of the reasons why we are doing a bit of further work on big tech is the scale of the data sets that they will have access to. At what point do they start to use those data sets to influence consumer behavior and take advantage of behavioral biases that are in the and at what point does that significantly negatively impact our consumer protection objective? We really want to get into that a bit more.
Do we have any questions from the floor? Thank you. I think we have a mic coming over to you.
Yeah, it's Charles Perry from JP Morgan Chase. Basically, when we're talking about global regulation or we're talking about going international, how is the FCA partnering with the industry in order to actually take care of the missing data from AI/ML? Because we cannot solve for problems that are not in the training data. So if we are looking at, for instance, the ChatGPT, or we are looking at anything else, if we're going to ask it any questions about anything to do with the different environments which are not digitally enabled, or we are talking about anything outside of the first 100 languages, we are actually going to be lost. And yet we're talking about global influence, we're talking about digital connectivity across the whole world, or international reach. So what is the exact partnership that the FCA has got with the industry in this direction to actually make sure that we've got enhanced data that is explaining some of these, changes in worlds that are outside the current digital domain?
So we have launched an AI partnership with the Bank of England. So we are the main sort of collectors of regulatory data here in the UK. We've done that particularly on AI to examine some of these specific issues. There's this trade-off between how much we seek to collect data at scale versus the cost of doing so, and because one of the biggest compliance costs is the cost of regulatory reporting. And then we are obviously talking internationally as well about how those data sets can be shared across border, whether that's trading data sets, margin, other things that you use in financial services. But your point around missing data, I think is, I maybe push that back to you. JP Morgan, you're one of the largest financial institutions in the world. I would expect as you're thinking about how to use some of these tools to be thinking about that through your risk management processes. And if what you're saying to me is you think that there is some instability or uncertainty in some of those tools, I think you'd want to be very careful about rolling them out to clients until you get a bit more confidence.
Hi,
Jason Maude from Starling Bank.
Hi.
How is the FCA thinking about the regulation of synthetic data, which you mentioned earlier, particularly in the ways of making sure that it actually genuinely is representative of what real data looks like, and it avoids bias and concentration risk if everyone uses the same two sets of synthetic data? For example, there's a chance that everyone could start hallucinating in the same way, which would be quite dangerous.
Yeah, I don't think we have the answer to that question yet. But what I can tell you, we've set up a synthetic data expert group. I don't know if you're on it or not, from Starling Bank, but to help us work that through. It's one of those new areas which we know we have to think about what the guardrails we put around it are, and we want a kind of fairly open conversation about what we should do. I've got a colleague from the FCA sitting just on your table, Enrique, there, who may want to add a bit more if that's okay. Josh?
Absolutely.
Enrique, do you want to add something? You've had a conversation earlier. Okay, you've asked my colleague asking me now as well. Okay. But I mean, actually, we would be interested to know, what do you think we should do around that in terms of regulation? How much should we rely how much we rely on our consumer duty, how much we rely on some core AI principles that, for example, the government has set out in its white paper, and the accountability mechanisms that exist within firms. One of the things I think that the regulated community is going to have to get used to here is that we're not going to be making rules and guidance for every single scenario. And because if we did that, it'll just be slow, and the innovations won't be able to proceed. So there's going to have to be a kind of shift in regulatory paradigm, I think, over the coming years.
Did we have one over?
Sorry. Nikhil, this is Prashant from IBM. You give various examples of global issues around AI. I mean, AI is globally used. There's no boundaries around it. How is the FCA thinking of regulating it, or regulation of this global issue? How do you think of collaborating with other regulators across the world, and technology companies across the world to try and regulate this new technology?
Yeah. Well, first of all, it's already here, and banks are using it, insurance companies are already using it. So it's happening today. I think there are different levels to this. So firstly, there is a sort of macro sort of leaders level conversation going on about what international compact around AI there should be. And that plays into national security questions, defense, and other questions. Questions around the extent to which the foundational models should be specifically regulated through, whether it's through an international institution or in specific jurisdictions. So we will have to then lock into whatever comes out of those conversations. The way we're thinking about it at the moment is really what I just said in my opening remarks, which is to allow the technology to innovation to proceed. To rely on the existing infrastructure that we have, our outcomes-based regulation. We're thinking about whether there's some specific model risk principles we need to implement, particularly to think around issues like biases, model bias, implementation bias, and so on. And then to provide safe environments for people to test ideas where they are concerned about them. And then to bring your international dimension in, we do some cross-border sandboxes. So working with partners, not just in the UK, but around the world, so you can test some of these ideas cross-border as well. So that's our current thinking. This is emerging. This will shift a lot, I imagine, coming years. And part of sort of me talking about this today is to sort of signal that we are really open for quite an interactive conversation about how we move forward.
I think we have time for one more. Well, maybe we'll try to do a couple more than one. One over here and then over there.
Yeah, hi Nikhil, this is Neeraj from HCL. I run an insurance business, and one of the questions I had was, and I think Angela made the point in the earlier panel where she was talking about corporations making their own large language models and trying to make their own version of ChatGPT. When and if companies, if they go that route, how would FCA be involved in that process? Because obviously, FCA's one duty is to protect customer interest and customer outcomes, and that's very important. I mean, I'm an FCA regulated person myself. So how would FCA think about that? Because see, obviously, when you bring your own version of ChatGPT, you will leverage some of the foundation models which are there out in the market. You might use data which is there in the market. There will be some internal data, and there you're going to lace them together and therefore use it for your advantage to obviously serve customers better. But would FCA have a role in that? Have you guys have any thought process around that if companies embark on doing that? That's definitely a consideration for my business. So I just wanted a point of view on that.
Yeah.
Thank you.
I'm skeptical that we'll want to go down the route of trying to audit those models ourselves, because I think that would be a very significant task for us. But what we'd be looking at is the senior leaders of that firm, the risk management processes, the testing, the validation that the firm itself has done before it has moved into putting its own large language model into place, into active service, as it were. And then I think it goes to the question which I surfaced, which is there going to need to be an additional accountability around specifically the AI developers and the AI officers who are responsible for some of the choices in these models? And when you talked about foundational models that are outside your organization, that's, I think, where the international conversation is going. And to the extent that should be international regulation. And the question for us is going to be, should we be thinking about that question also within the regulated financial services domain as well? And that's an open question.
Good morning, Nikhil. James Boucher for Bank ABC. You mentioned that the FCA was considering new standards for the cloud service providers. Obviously, you mentioned it's easier because there's a small number of them, but does that oligopoly pose challenges for you? Can you tell us a bit more about what you're thinking in that space?
So there's new regulation on its way in the UK for, with respect to financial services, the regulation of critical third parties, because they are systemic nodes of resilience now for the financial services industry. We have had long-standing rules around operational resilience, and the traditional approach has been the outsourcing firm takes responsibility for its third parties. And that remains at the core of what we do. But the reality is, with these cloud providers, there's a limit to how much, some of you may be small business, I don't know about your bank, the ability that you're going to be able to dictate terms to the large cloud provider to make sure that your services are resilient over and above others is going to be challenging. So we will be looking at the standards that they have in terms of all the traditional things about resilience, testing, availability, backup, provision, the manner in which they are communicating with customers when things go wrong. And I think you're right to call out that there is a tension between introducing regulation, which at one level creates barriers to entry because it creates costs, and only a small number of firms may be able to meet those costs versus competition. And we're very mindful of trying to make sure we've got a proportionate regime in place, but we also have to accept the reality that there's a small number of players that are now systemic for the financial services markets, and we have to make sure we have our arms around them.
I think that's just about us running out of time. So could you please join me to thank Nikhil for a really fascinating discussion.
Thank you very much. Cheers. Thank you, Josh. Thank you.
So we've heard about, quite a few things that are here to stay. AI, I think, conclusion not going anywhere, even if ChatGPT might be a bit worrying to people like me who write for a living. Quantum computing coming ever closer down the track, and whatever you might think of them, blockchain and cryptocurrencies probably not going anywhere. We've heard about banks transforming into tech firms, whether they like it or not, and that line between big tech and banking blurring in the way that it's already blurred between big tech and the rest of our lives. I have to say, I'm quite pleased to be in my position watching and writing about this stuff rather than Nikhil's trying to set some sensible rules to actually govern it. So thank you to all our speakers again, to the Bahrain Economic Development Board for sponsoring this session, and of course to everybody for coming. And I think lunch is being served next door.